final AICDP webinar of 2020, and what a year it's been. We've got more webinars planned for 2021, so I hope you can join us on the journey, and we'll be giving you a bit more information about those later on today. But today I'm delighted to be joined by Joe Kettner, CEO of Company Watch, who's going to be talking about, are we facing a trade credit crunch? So I'll pass over to Joe very shortly. But first off, I can see that we've got a few people on the call today who may not know what AICDP offers, who we are and how we can help. So I thought I'd just take a few moments just to say hello and introduce AICDP to you. So AICDP, we've been an organisation now which was formed in 2014 when a group of credit directors got together and could see that there was an opportunity for an organisation that helped with everything to do with education, through training, but actually developing the organisation and supporting members as they transition through their credit career. And the main aims of the organisation is to raise the standards, to share best practice, to utilise the power and the benefit of the group to support our members as they, whether they're whatever level of or whatever career point they're in, we are here to help support and guide really, and also through our education and training programme. We've geared up the organisation to support credit professionals however they want to get ahead. So just a few bits about AICDP. Our membership it's actually just over 350 members at the moment, and we are growing month on month. And what is interesting is our membership is reaching a truly global audience. I think we've got 19 countries, so our membership consists of 19 different countries are represented by the audience, and we do support the credit community, not just in the events like the webinar that you're coming on to today, but we do normally have quarterly events in the UK, Europe and further afield. And so you will be finding out more information about those as soon as we can physically meet face to face, but it will be Zoom for the short term. The power of the group is second to none really. There is a huge amount of knowledge, expertise within the AICDP members, the corporate partners and the organisation and executive committee as well, which is a really powerful thing for a lot of our members. They can tap into that knowledge. We've got an active social media group, we've got an active events programme, and it's one of the things that does keep being reported by our membership base is the amount of knowledge that we have available at our fingertips to actually help members with whatever it may be that they need. So the other benefit I wanted to share is that our membership is free. Now, I wanted to say a real big thank you to our corporate partners who support AICDP year in, year out. It's because of their support that we're able to keep the membership as it is and bring these events to you. But also it gives them an opportunity to share their knowledge, to reach new audiences and build and help and support our community. So I've talked about the benefits. There's a couple more on there. We have a very detailed education and training programme with AICDP. So whatever you're looking for, whether it be for yourself, if you're advancing your career, or if you've got a team that you're working with and you need extra support, AICDP has got the training and education programmes designed specifically for you. So if anyone is interested in any of those, if they could if you could visit the website aicdp.global, or our email address will be on the screen shortly. If you want to get in touch, then we can point you in the right direction and give you an idea of what training and education is available. And we would invite you all to join our social media groups as well on LinkedIn and Twitter, so that you can find out more information about the events, meet some of our members and find out what we're all up to. So If you are not a member of AICDP already, then we hope that you would like to join us. If you would, it's a simple case of going to the website aicdp.global, and from there is a become a member portal. A few short questions, or you can email me or give me a call on the number on screen, and I'll be delighted to talk you through AICDP and answer any questions that you may have. So that's my short piece over and done with. I would like now to pass you over to Joe Kettner, who will be talking to you about, are we facing a trade credit crunch? So Joe, over to you.
Hi, thanks very much, Claire, for the intro. I'm just going to switch onto my screen for now. I hope everybody can see that okay. So hi, welcome to this afternoon's webinar, and thanks very much to Bill, Chris, Claire and the team at AICDP for inviting me along. Just a quick word about, I'm just going to turn my video off. I'm in rural Kent and I've had a few issues with bandwidth and things. So I think at the risk of collapsing with trying to use too much with video and webinar, I'm going to turn off for now, but obviously I'll come back on at the end when we've got questions and so on. The other thing I wanted to, sorry, I don't know whether actually Claire, maybe you can turn my video off, because I now have no idea how I go about stopping video. As an introduction to me and Company Watch, we're a credit reference agency, and we specialise in providing financial risk management tools to help our clients manage their exposure to credit and supply chain risk. We're one of 7 members of the Business Information Providers Association, BIPA. The others are DNB, CreditSafe, Graydon, Experian, Equifax and Vistra. We meet monthly on a strictly non-competitive basis to discuss issues that are relevant to the industry as a whole. And the presentation I'm going to give today is broadly based on an article that I wrote for BIPA earlier in November, highlighting the issues that we as an industry are concerned about, which frankly I think anyone who's got an interest in using company information should be aware of. Again, we're having a bit of a COVID. We're in Kent, we're in tier 3. My children's school closed last week. So we're homeschooling at the moment. I've taken steps to shut myself away, so I don't think I'm going to be child bombed, but apologies in advance if there's any interruptions, but hopefully I've secreted myself in a nice quiet place. So before we start, what I'd like to do is just take a snapshot of the audience today. So, in normal times, it would have been really nice to have been presenting to you all in person and to have had a chance to meet you and find out who's in the audience. I mean, it's an AICDP event, so I've got a pretty good idea of my audience I'm looking at, but I think perhaps we could try and create a little word cloud if possible. So I'm going to start a poll, and what I'm asking you is your job role. Now, with word clouds, typically we try to keep those to one word. So if you're a credit manager, perhaps you could keep that as one word, capitalize the C and the M, credit controller, accountant, supplier, information provider, and so on. Let's hope this works. I haven't got a brilliant track record when it comes to technology and things working, but let's give it a go. So if you could go to pollev.com, and then in the / section, you can see the instructions on the screen. Type in Company Watch 098, and that should allow you to put some responses onto this poll. As I say, we sometimes struggle to get things actually working in a live environment. So let's give it a go and see if anything actually happens. Occasionally, it helps if I go onto full screen. I don't know, Claire, are you having any luck in?
I'm just trying to log in now for you.
Thank you. So it's pollev.com / when you get to the little entry box, Company Watch 098. I think maybe my technology curse has struck again. Again, sometimes I have activated. That's normally my problem here. Oh, fantastic! We've got one result. Brilliant. Thank you. Again, apologise that sometimes this isn't always as as quick as possible. Well, I can have a look at the end. I suppose this is actually, I've had experience of this where actually at the end I look back and suddenly the word cloud is magically populated. So I shall let you answer this poll. It'll still be active, and maybe we can have a look towards the end of the presentation. What I wanted to really discuss, the point of today's talk is to just ask, are we facing a trade credit crunch? And we've got about 30 minutes, I suppose, to do a bit of a whistle-stop tour of why this is a relevant question, some background, what was the financial health situation of companies pre-COVID, if anybody can actually remember that far back, and what the outlook is like, what's changed in the business information space. And my kind of too long didn't read version is yes, you know, I'm worried about this, the industry is worried about this trade credit crunch, and in particular that the government action is potentially contributing to the crunch that may come. Now, you know, I'm sure I speak for the Trade Association and I guess most of the audience in saying that trade credit is going to be a really key factor in the economic recovery in 2021 and beyond. And in terms of recovery, we know that business confidence is going to be absolutely key to recovery. And that's confidence in the regulatory regime. And yeah, I probably mean deal or no deal Brexit. And, you know, frankly, we haven't got time to go down that road today. You know, we'll maybe know more about that over the weekend, maybe not. So I'm not looking at the regulatory side of things today. But what I am interested in is the confidence in being able to trade within our own risk appetites, by that kind of ability to feel confident to work on credit terms to smooth the flow of cash within the economy, allowing that working capital breathing space for value to be created and for the economy to prosper, which is what, you know, the trade credit space does. Now, let's just wind back a little bit to the situation before COVID. So the government has spent quite a lot of energy over the last 10 years trying to get money to SMEs, creating an environment that allows businesses to thrive. And the focus has been very much on lending. So both understanding the traditional bank lending markets, but also encouraging and allowing, in fact, the growth of alternative finance. Now, much of this was triggered by the Breeden Review into financing of SMEs, which was set up in the wake of the original credit crunch back in 2007, 2008, which is following obviously the banking crisis. But there are some signs that the emphasis on traditional forms of finance, which weigh quite heavily on balance sheets, so things like loans, overdrafts, asset finance, and so on, is having a detrimental effect for a significant number of companies. And what's happened, although they may have taken on finance to fund growth, actually they've ended up becoming slaves to paying back debt that they've taken on. And, you know, in the current jargon, these are called zombie companies. And a zombie, in the definitions kind of vary, but it's a company which essentially is laden with excess debt, and the exact amounts vary. At Company Watch, we tend to look at businesses where the liabilities exceed the assets by at least £10,000. And although the business is able to function, you know, it can generate cash. What happens is that after kind of covering the running costs, they've only got enough funds left to service the interest of their loans, but not the debt itself. So there's this sense that they're generating cash, but all they're doing, instead of paying down debt, they're just servicing the debt. Earlier in October, Company Watch was asked to provide some research to the Daily Telegraph, who are writing a piece on zombies, and we estimated that around 262,000 businesses are zombies in the UK, and that's probably an underestimate because we only included parent companies in the sample to avoid that problem of double counting group accounts, group balances, and so on. And you can see on screen the amount of negative equity is an astonishing £108 billion. And looking back at the situation in 2016, where we had half the number of zombies, but the negative equity has increased over that period by 140%, from 44 billion to 108 billion. And that's, you know, those are pretty shocking figures. And we've got to not forget that these are actually figures that are not taking into account the COVID situation. Because of the filing regulations in the UK, the data that we ran that analysis on were period ends, from 2018, a few 2019, but mostly 2018 period end accounts that were available at Companies House. So, that really is on the eve of the COVID crisis, what the situation looked like. And the question then is, well, why is this problematic? Why should we be worried about it? And it's worth kind of looking a little bit at the analysis that the Daily Telegraph did on the basis of this research. And there are kind of four key things that they pulled out. The first, obviously, is contagion. So the companies themselves is an unsustainable business model, and therefore it's risky to do business as a supplier or customer of that business. It's risky to engage with them. And then, of course, you have that issue of potential contagion across the supply chain if they do topple into insolvency. And of course, although we might be forgiven for thinking there are limitless amount of resources, we've had the huge quantitative easing program for the Bank of England, there is a finite amount of resource in the economy. And by having resource sunk into these companies that aren't really doing very much to generate growth, that's using resources that could be better employed elsewhere and could actually help the economy grow elsewhere. The OECD, the Organisation for Economic Cooperation and Development, did a survey or study really in 2017. And they found at that point that about 7.5% of UK capital was stuck in zombie companies. And they worked out that every percentage point taken by zombies brings about a 1% decline in employment growth among younger firms. So again, that kind of suppression of employment, of recovery, of opportunity. And finally, and this is actually a really interesting point, I think, from Bank of America Merrill Lynch. And the first part of what they say is not a surprise. So they say that build-up of zombie companies can make it more difficult for economies to escape vigorously from recessions, and it can potentially hinder longer-term rates of growth. But they also found that even recovered zombies underperform their peers for years afterwards, and they remain more vulnerable to a relapse. So in fact, actually having zombie companies that emerge from their zombie state isn't even necessarily as good a thing as we might imagine. And looking at the kind of insolvency, we also were having a rise in insolvencies in the UK in 2019, over 18,000 insolvencies, which is the highest level since 2013, and about a 4.7% increase on 2018. And in January 2020, so again pre-COVID, the credit insurer Euler Hermes was predicting that there would be another 3% rise in the insolvency figures in 2020. And I'll come back to what the current thinking is a little bit later. So back to today and looking ahead to the future. We came into this COVID crisis, we had a harsher trading environment and more indebtedness. And as we know, there's been an absolute explosion in bank lending since March. So let's look at the latest figures. These are taken from the Treasury website. There's quite an interesting range of stats on the Treasury website. I've given the link to where I got these from. It's quite, you can spend many an hour foraging through for interesting bits and pieces in there. So let's have a look. I've got the bounce back loans and the CBILS, the coronavirus business interruption loans, the details, and the latest figures we've got are up to the 15th of November. They publish these figures monthly now. So we've got £42 billion that has been lent in bounce back loans, and another 18.5 billion that's been lent in CBILS. And then for larger companies, there was another scheme that was operating, and that's lent almost £5 billion. So that comes out at around 65.5 billion, about 3% of GDP, which has been loaned in the space of 7 months, and that's new borrowing. And what is there to say about this? I mean, it's bank money that's been allowed to flow out. So the Treasury is guaranteeing the loan, but we've got to remember that that's a guarantee for the lender and not the debtor. And the banks themselves are going to be responsible for collecting the debt. You can see there was a big jump in the amount lent between October and November because the rules of the scheme changed when we went into the second lockdown. The bounce back loan rules allowed businesses that had not borrowed up to their maximum amount, which was £50,000 or 25% of turnover. Originally, the rule was that you could only apply for one loan under that scheme. And if you didn't apply for the maximum, it's kind of tough, you couldn't come back. When the second lockdown came, the rules were changed to allow businesses that had, even if they'd previously applied, they could go and top up to the amount that was available, that 50% or 25% of turnover. There's been quite a lot written in the press recently about the concern over just how much of this money is going to ever be repaid. The National Audit Office estimated that as much as 26 billion will be written off, and that's both due to fraud, and there's been quite a lot of concern about fraud. Maybe that's something we don't really cover that very much in what I'm going to say now. That may be something to discuss in the Q&A at the end. And also, obviously, people being unable to repay because the businesses aren't viable. And you also look at the acceptance rates. So the bounce back loans deliberately were set at a very low criteria for acceptance. So you get about an 80% acceptance rate on those. The C-bills and the SIL bills, which is the larger scheme, adopted a more kind of rigorous underwriting approach. So the acceptance rates for them are lower, about 45% on C-bills. But I suppose the big point is that, if we think we had a problem with over-indebtedness before COVID, that's looking a whole lot worse now. And a couple of other things that I just wanted to point out here, that there's an all-party parliamentary group on fair business banking, and they've raised an issue that, and it's kind of ironic given what the Breeden Review was set up to do in terms of enabling SMEs to have more access to finance and to kind of try and break the stranglehold perhaps of the traditional banking sector in SME finance terms. This group on fair business banking has said that there are about 250,000 SMEs have been unable to access the bounce back loan scheme because they bank with either lenders who are not approved under the scheme, or even if they bank with lenders that are approved under the scheme, that the funds that those alternative finance providers have got to loan have dried up. So they weren't able to access the cheap Bank of England funds that were made available to try and finance these things. So that potentially is an issue in terms of availability of bounce back loans. The other thing is that there's a little bit of a concern, and not very much has been talked about this recently, and I think this is something that will become an issue in 2021 and beyond, is that this type of borrowing is skewing the market and maybe putting pressure on alternative providers. So anybody who's needed funds, the first port of call really has been the bounce back or the C-bills, because cheap interest rates, a 1-year payment holiday and so on. And so if that has caused the appetite to use the alternative markets to kind of dry up a little bit in this period, and for SMEs to be used to almost a kind of artificially cheap form of lending via these schemes, that could be a problem for what the future looks like for those alternative finance outfits who have been really a key part of driving growth and over the last few years. And I think the other reason it may be worrying is, as I said, that alternative market has tended to drive growth, and that's what we need. So if we think that the money that's been lent now is to shore up the survival, then looking at how we're going to grow and to actually come out of this current downturn is, business investment will be key, and where is that money going to come from? So, I think it's kind of interesting to delve into these bits. But then, on the other hand, anecdotally, I've been hearing from finance directors, forums and so on, that actually up to 50% of the money that was lent under the bounce back scheme hasn't been spent yet and is kind of there for sitting in accounts still. So it may be that safety net that people have taken on could be used to fund growth. It may be paid back, we don't know, but I think there is certainly quite a lot of things to still think about in terms of the money that's been lent out. The next slide is, I think it just shows quite how dramatic the change has been in terms of SME debt. This is taken from the Bank of England's money and credit report. The latest figures I've got are for October 2020. And you can see there's been an enormous rise. The very kind of faint grey line is the SME lending. And that's gone up to almost 25%, which is, as you can see from this, it's the highest on record. And it's kind of interesting because it's reversing that split. So the larger businesses, obviously a big spike in lending at the outset of the crisis, but actually that's been quite a lot of that money has been paid back now. I think it's beginning kind of end of the summer, larger businesses were starting to pay this money back. But for SMEs, the demand for lending has really increased. And we're kind of in uncharted territory really here in terms of what that means. So in this background, we're expecting perhaps a tightening of traditional lending as banks in particular are kind of bogged down in the detail of trying to get repayments back from the business interruption loans. And so trade credit is going to be a really big part in fueling the recovery. And there's been relatively little emphasis on the importance of trade credit. I was at a seminar the other week with one of the Bank of England agents, and I asked that question about, how they view trade credit. And they were very much looking at this through the lens of credit insurers, rather than, that kind of commercial exercise of trade credit that I think is probably more familiar to us. And credit insurance obviously has a very wide range of products out there. Not all of it is kind of whole turnover. You might have kind of individual risks that are picked up. I think the world of trade credit is much more nuanced and diverse than perhaps is seen in official circles. And I'd like to just quickly have a look at some figures from the British Business Bank. So British Business Bank was established in 2014, again, as a result of the Breeden Review I mentioned earlier on. It was an attempt by the coalition government to get better access to finance for SMEs. Bad timing for this survey. It was published on the 27th of February 2020. So it kind of got a little bit lost, I think, in all the COVID events. The survey is done every year by British Business Bank and looks at SMEs, and typically they will do their research between August and November the previous year. I'm hoping very much that they will have done it this year and that we'll be expecting a report to come out in 2021, because I think we really need to have some updated numbers. I could have a guess about what they might look like, but it would be quite good to have a that continuity of reports so we can see how much things have changed. And you can see here that the use of trade credit has increased slightly in 2019. So it went up to 37% of respondents said they used trade credits, and that was up from 34% in 2018. And just over a quarter of SMEs said that trade credit reduced their need for external finance. And we can see that external finance and trade credit are being used kind of as complements to each other, as we can see from the charts. The frustrating thing slightly about the report is we don't know the size of the businesses. The statistics are phrased in terms of numbers of respondents. I don't think it would be an unreasonable assumption to make that it's the larger, more significant SMEs that are using both trade credit and external finance, and obviously their contribution to the economy is that's bigger. So I think it is an important thing, even though we're perhaps looking at under half using trade credit. I think that those will be quite significant contributors to the economy. And then just looking at the European view. So again, we can see that the UK uses trade credit much more than other European countries do. And interestingly, kind of historically, UK companies have been less reliant on bank loans than their European counterparts. Again, I'd expect that to be quite a different picture if we look at the numbers that come out next year, but historically that's been the situation in terms of bank loans versus trade credits. And interesting that perhaps there is actually an opportunity for European companies there's more room to grow in the trade credit space, and maybe that will be something that will be on the increase in European countries. That might be something interesting to ask those of you who have exposure there, if that's been your experience. The thing that I also want to point out about the survey, and again, I don't know quite how to interpret this. The British Business Bank said that 70% of SMEs said that they would forego some growth in order to avoid taking on more debt. And so on the one hand, I'm quite worried about this explosion in debt. You know, if in the past people have been quite reluctant to take on debt, and we've suddenly, you know, had these millions of companies that have taken advantage of the bounce back loans and the business interruption loans. You know, what does that mean in terms of understanding how to operate a business with this debt that perhaps they're not used to before? It's suddenly operating kind of almost outside their experience. And I think, again, that's something to keep in mind, that there is, you know, historically there's been a reluctance for SMEs to take on debt. Now we're having SMEs taking on debt in huge numbers. And what does that mean in terms of being able to kind of manage their businesses with this kind of new context? And I said I'd just come back to the insolvency predictions. So in July this year, Euler Hermes kind of reissued their forecasts, and they predicted that there would be a 43% rise in insolvencies in 2021 compared to 2019. And so they were looking at around kind of 23,000 insolvencies in 2020, and then 31,500 in 2021. Now, I think the 2020 figure is probably an overestimate. You know, that was July, that was before we'd had the extension of the measures, again, which I'll talk about a little bit later on, which makes it actually quite hard for companies to go bust at the moment, with the, you know, the enforcement of landlords clauses has been banned, winding up petitions, very difficult to get at the moment. So I think that we're probably going to see, again, we're end 2020 with an artificially low level of insolvencies. But the danger is if there's a cliff edge in January, then you know, we'd expect a wave. It's worth also saying something about the courts themselves. So I was at a CICM think tank recently, and representatives of the court users there were saying that actually the system is under so much pressure, as such a backlog to get through. And if there is a flood of petitions in January, it's likely to take quite a long time to get through that backlog. So I don't know, it feels to me that the trade credit is a kind of great hope for recovery, but you need confidence. And you know, you need confidence in the information. You need to base your decision about whether to extend credit terms and amounts on information, and that's got to be complete, credible, and reliable. I feel like I'm almost going to kind of fall into that definition of what is it, madness is like doing the same thing and expecting a different result. But I'm going to have another go. I'm going to try another poll and see if it works this time. So what I'd like to ask this time is, what do you look for when you extend credit? Again, it's a word cloud, so try and keep your answers to one word. So you have multiple things like, I don't know, financial ratios, but put those as one word, please. But you can respond as many times as you like to this poll. So let's see if that works this time. So same deal as before. Go to pollev.com, and then the login details you need are CompanyWatch098. And we're looking for what are the key things you look for when extending credit. Let's see if we have any better luck. Oh, brilliant! We have it's working. Internet is working somewhere. It could also be my end as well. I've got a kind of a laggy connection, so apologies if it's not working very well. I'll give you a couple more bits to put in. Great. So we're getting a few things. Interesting growth. So we can keep those coming. Again, I will leave that poll on, and Claire, if if it does work, we can always share the results at the end. So I'll leave that. That'll still be activated, but I'll just kind of flip back to my presentation for now. I hope if I can do it this way. Yeah. And I know that, although regardless of the technical difficulties, I mean, nobody is saying on that, we're consulting the tea leaves, or we're looking at our crystal ball, or we're not looking for anything. There is some need to have information, and you need to have confidence that the information is credible and means something. So what's happened? I think the difficulty is that the government in March and April time was faced with a situation where if they didn't do something quickly, then there would have been a lot of companies being pushed over into insolvency quite quickly. And I think there can be no doubt that the interventions they took, certainly in terms of the loans and the money getting out to businesses so quickly, saved a lot of jobs and livelihoods. But there was a kind of unintended consequence, I think, of some of the measures they took. And I think it also drew into sharper relief some of the issues that we have with information in this country, and how reliable and how up to date it is. So let's just quickly have a look at what happened in the Corporate Insolvency and Governance Act. I hate to use this phrase, but some of the measures that were introduced here were kind of oven ready, as it were. They'd been consulted on over a number of years, and were pretty much ready to be put in place. And this wasn't all done in a hurry, and that's certainly true of the moratorium process, which can be triggered without prior notice to creditors and just gives a breathing space for companies to try and to sort themselves out. The continuation of supply requirements, again, I believe that was consulted on beforehand, and this is tricky, and I think this is something to really be mindful of, and why information is so key, and these points about how can you make decisions. So if your customer is continuing to meet their side of the contract, then the fact that they've gone into an insolvency process is not a reason for you to stop supplying. Clearly, if they haven't paid within the agreed terms and so on, then that's a different situation. But if they have kept up with their with the requirements on their side of the contract, then insolvency isn't a reason to stop supply, which is clearly quite a concerning situation. There was a temporary ban on the use of statutory demands and winding up petitions. Again, that it still is the case that the reason has to be COVID related, for a company being unable to pay its debts. But as we've gone through the year, the kind of case that it's not COVID related, that somebody is not able to pay their debts, obviously is more difficult to argue. We had the suspension of wrongful trading provisions, so that's directors continuing to trade when they know that they're not able to pay all their bills. Originally, that expired at the end of September, and it wasn't extended along with the other provisions. But actually, in November, I think again pressure with the second lockdown, that was reinstated in November and runs, I think, until the end of April now. And then there was a statutory instrument that was passed at the end of June to extend the deadline for companies to file financial information at Companies House by 3 months. Now, that was quite controversial because the credit reference agencies weren't told that this was going to happen. There was earlier in April, Companies House had been very lenient about accepting an application for a filing extension, and have basically automatically granted those. But the change from it being a kind of a request to an automatic right was something that was quite unexpected. And I think that we as an industry were put out by that, I think, because it seemed to be a bit of a window dressing display, because corporation tax deadline wasn't changed, and for most companies would fall into this category where their taxable profits are up to 1.5 million. And as I say, I think about 75% of companies fall into that category. The deadline to pay corporation tax is 9 months and 1 day after period end. And penalties and interest are applied for late payment. So essentially, SMEs will still have to prepare their accounts in the normal time frame. And again, you don't have to submit your corporation tax deadline to HMRC until the actual end of the calendar year, but you'd have to pay the money by the 1st of October. So we were kind of in this position where financial information existed, but it wasn't being made available for third-party risk assessment. And it's a similar story with the business interruption loans. So, as I said, that initiative to get money out was amazing, and it did save jobs and businesses. But there's a lack of visibility about the businesses that have got those debts. And we've got 9 UK banks which are part of the commercial data sharing scheme, and they're mandated to share current account information with designated CRAs. So some of the information will be available, but only 80% of the loans have gone through the designated bank. So still 20% of the firms that were able to offer these loans are not part of that designated scheme. So again, we've got a situation where we haven't got a full set of information. We may have some information, but we don't know that it's a complete universe. So the absence of information doesn't tell us anything. It just tells us that a company doesn't have a loan from one of the 9 designated banks, but it doesn't necessarily mean they don't have a loan. And insolvency practitioners have been asking the British Business Bank to make available a list of companies that have taken out these loans. And the idea is not necessarily not at all to restrict businesses from obtaining trade credit, but it seems only reasonable that organisations that extend credit terms understand the current financial situation of the customer, and it's surely in everybody's interest for credit to be granted at an affordable level. And once you start restricting information, you potentially get this cloud of caution that descends over the trade credit space, because people are worried about not necessarily having enough information to be able to make a judgment. Or, frankly, even worse is that trade credit is extended to businesses that aren't in a position to repay it. And then, we start that contagion problem. And I thought this is an interesting thing. I'm just as a final thought, really, this cash flow cliff edge that SMEs are facing. Although I think actually yesterday, I haven't seen the proper announcement. I saw something on Twitter that the landlord enforcement ban has actually been extended again. And I'd be amazed if the winding up petition ban isn't extended again beyond the 31st of December. So those perhaps aren't going to be quite the biggest problem. But January, we've got the self-assessment debt due. That's also the July payments that was extended to January. We've got potential changes to the employer contribution in furlough coming in January. Then February, we've got the Christmas quarter VAT. And then March is where everything really kind of comes together. We've got the end of the business rates holiday, rent quarter day, 25th of March, I think. Furlough scheme is ending as things currently stand. And we've got the VAT. If you remember, companies were allowed to defer their pre-June 2020 VAT until the end of March. So that will become due. So, there's quite a lot of pressure coming over the coming months. And so understanding the situation of your kind of key SME customers is going to be really, really vital. And we're trying to engage with government as an industry to work with them to kind of work out what other information we might be able to make available to people who use our data. In particular, one thing that we think might be interesting is the use of real-time information, the employee numbers on real-time information. The government have indicated that they will publish information on furlough claims from December, but that's not due to be available until February or March time. So again, that's another kind of indicator to see how a business is perhaps performing in terms of numbers of staff on furlough. But I think the voice is stronger the more people can join in. So anybody who feels like they're kind of like to lend their voice to the arguments that we're putting forward to BEIS, Treasury and so on, we'd be really interested to hear from you. And then just as a final kind of practical thought, you know, now more than ever, you've got to be able to interrogate the information you've got in front of you. And I think we've got to accept that you can't do that with every risk. So being able to understand criticality is, you know, I'm afraid like a one-by-one review that needs to be undertaken. For people who use Company Watch, we developed a COVID forecast score, which we released in April, and we're updating the scenarios with the Office for Budget Responsibility scenarios that were published at the end of November. So we'll do that in the next week or so. So just being able to kind of forecast forward and see what on a kind of industry-based scenario level, what that might do to a latest set of accounts, and then being able to interact and recategorize may be useful. That's free of charge to all our customers. We kind of launched it to everybody. So, you know, if you haven't used that already, I'd strongly recommend that you do look at that. So that's all from me, Claire. I'm not sure, I realised I wasn't really paying attention to my timing, so apologies if I've gone horribly over, but I think that's all from...
No, you're fine, honestly, Jo. Thank you. Thank you so much. That was really insightful. There's a lot there for us all to take away and have a look at. So I really do appreciate you taking time this afternoon to join us, really. And now this is an opportunity over to you. If you've got any questions for Jo, Jo is happy to answer them while we've got you on the call today. So if you want to pop them in the chat box or the Q&A session, I'll sort of curate them for Jo. I think you should still be able to see them on screen as well, Jo.
Honestly, I'm so lost. I don't know what I'm doing. So just help me.
That's okay. Honestly, don't worry. We have had a couple of questions come in. So we've had one come in on email sort of saying, Jo, do you have any information on the company house reforms? Is there anything that you could share with us on the screen, on the call today?
Yeah, sorry, I should have picked up a little bit on that. So yeah, for those of you who don't remember, there was a big consultation launched in the summer of last year on the future of the register at Companies House, and in particular, the area of focus was on verification of director identity. And it was very well responded to, actually. And you know, Companies House and BEIS, who are the kind of like the governing department for Companies House, did quite a lot of engagement with various stakeholders. And we hoped, so we spoke to BEIS, who are running it, in February, and we were really encouraged by what they were saying in terms of the recommendations they were making. So director of verification using passport or whatever would be coming into force. But that was February, and there was a delay with the government, with the election and the reshuffle. That was being delayed until March. Then COVID hit, and so finally in September a response was published, which is great. But all the timescales in there hadn't been updated. There was not a single mention of COVID throughout the response. So I think it hadn't really been updated on the basis of what we've gone through over the last 7 or 8 months. And again, in our kind of discussions with BEIS, they've said, look, all those timescales you really have to take with a pinch of salt. And it's such a shame, because I think the government, especially with what the National Audit Office is saying about the amount of fraud that they're expecting to kind of be victim of in the bounce back loans, which, you know, essentially is because of the lack of verification of information at Companies House. You know, I was hoping that may have taken a bit more seriously the need to really to carry out the reforms that they're consulted on. But, you know, I'm not really holding my breath for anything anytime soon on that. So yeah, it's a bit disappointing, because I think it's a huge opportunity to try and tighten up the governance at Companies House, the information that we all rely on. But yeah, I think we're going to have to wait a little bit longer into 2021 before we see any kind of real movement on that.
No, thank you very much, Jo. And we've had another email to say that somebody had to drop out of the call quickly, but could they get a copy of the presentation?
Yeah, of course. Yeah, yeah, that's fine. Absolutely. You're recording this as well, aren't you? So the recording, I guess, is available.
Yeah, we will send a copy out to everybody. So don't worry on that score. So I just wanted to make sure you were happy to share your slides, Jo. That more.
Yeah, of course.
So thank you very much. We've got another question that's come in. So how has CW fine-tuned the ratings model to reflect what you have presented today?
So this was the on the COVID score front. So we, in common, all the reference agencies will look at accounts typically as our kind of main kind of spine of data, and so we looked at the OBR forecasts that came out in, well, they weren't forecasts, sorry, I always get told off, they're scenarios in April that were particularly not forecasts, which are on a sector basis. And I think we've got about 22 different sectors. And we kind of looked at those and looked at other kind of industry publications to try and see the likely impact per sector on the companies. So then we launched a kind of module. So when you log into our system, for companies that file full accounts, you'll see a COVID forecast, and that will be taking the SIC code at Companies House and applying a scenario. Now, we all know that SIC codes at Companies House are not brilliant, so you can change the sector. So, for example, I think Next is a classic that's kind of a holding company, and so you can change that to retail and non-food, for example. And that just kind of applies a set of parameters over the accounts and says, this is what we think are kind of a best estimate of what might the impact be on this company. And then you can analyze in more detail. So if you have management accounts, you can put those through the system and update your scores accordingly, and you can tweak our parameters. So we've got, I think, five parameters that we use, looking at changing revenue, cost of sales, direct costs, bad debts, and depreciation. But you can go and do a much more detailed analysis using the models, and then kind of get an updated forecast from that.
Brilliant, thank you. Another one is, is the COVID score variable to reflect different country conditions and policies?
So at the moment, this is just UK. We've only done this on the UK base. We've got a country score that gives you a kind of general overview of what the economy in the countries globally are. But for this score, we've only done UK. Again, it's just, we were often asked, we like this on a portfolio basis. We want you to apply this to our portfolio of companies. And I think there's no quick fix. And if you try and apply industry-based scenarios to a bigger population without really reviewing one by one whether it's appropriate for whether the industry that you've allocated because of an SIC code is appropriate to it, I think you can get quite distorted view of reality. And I think there's no quick fix, really. I think you do have to kind of review on a one by one basis. And what we were trying to do was to give you a kind of head start in saying, well, this is what the kind of like official research says in terms of the impact on different sectors of the economy. So this is how it's applied. But you need to, your customers or your suppliers, better than we do. And then you need to go and kind of talk to people. And again, I think I'm sure most people on this call would subscribe to that view, that picking up the phone and finding out how your customer is doing is actually a really good way of starting. And then any information you can get from that to be able to put through is then more information that you can use to deal with this.
Brilliant, thank you very much, Jo. There's no other questions coming at the moment. Are you happy for people to contact you if they have got any questions about what you've presented today? Are you happy for people to make contact with you? And
yes, absolutely. So sorry, I think you asked me to put my email address on my presentation. I failed visibly, apologies. So you can send out, or it's jkettner@companywatch.net is my email address at the moment. But you will get an out of office saying I may be in the middle of homeschool. So I will do my best to get back to people as soon as I can. It's a bit chaotic at the moment here.
Oh, bless you. Honestly, don't worry. I will send Joe's contact details out with a copy of the slides and copy of the presentation for you. So don't worry on that score. Joe, thank you ever so much for this afternoon. Really enjoyed it. So just wanted to say a big thank you to you for sharing your knowledge and sharing your presentation this afternoon.
Pleasure.
We'll be running a number of other webinars in January and February. Details will be announced very shortly on the AICDP website and on our social media channels. So if you haven't joined, we have got a LinkedIn group. So if you search for AICDP under the group section on LinkedIn, you'll spot it. And it is a forum that you can ask questions there as well. So if you do need help and support on any aspect of the credit industry, then please post it there, and we will have corporate partners or members who will be able to help you. So thank you to you, thank you to Joe, thank you to everyone who's joined us this afternoon. Really enjoyed it, and like I say, we will be sending out a copy of the presentation. So thank you very much.
Great, thank you. Yeah, any other questions? I think I might have missed one on there, but I'm just struggling to read and think at the same time. So I'm very happy to take any other questions afterwards.
Brilliant. Thank you, Joe.
Thanks.